Hey everyone, and welcome to The Explainer. Today we're unpacking a really fascinating dynamic that's currently playing out in the US equity markets, specifically with the Vanguard S&P 500 ETF, or VOO. Right now, there is this massive tug of war building up just underneath the surface. It's basically a battle between incredibly strong corporate fundamentals on Main Street and the highly uncertain economic policy coming from the Federal Reserve. We are going to break all of it down so you can see exactly what is driving investor sentiment right now. Let's just jump right into the numbers, shall we? VOO is currently sitting right around $710.27. Now, we are seeing a modest daily pullback of about 0.5% right now, but please don't let that obscure the bigger picture here. Year to date, this fund is up an impressive 12.5%, and we've already witnessed multiple record highs this year alone. But hey, surface level performance only tells us what has happened, not why it's happening or what comes next. To really understand that, we need to look under the hood.
Here's our roadmap for today. The state of VOO, the earnings engine, reading the charts, the interest rate wildcard, and finally, 3 key takeaways. Let's get right into it.
All right, Section 1, Lens 1, the earnings engine. So this right here, this is the bedrock of the optimism we're seeing. Corporate fundamentals are literally the engine powering these record highs. We're talking about a massive 31% year-over-year earnings growth for the S&P 500 in Q2. I mean, wow, that is spectacular. To put that into perspective for you, the consensus estimate was sitting at 23%, and these companies just completely blew past it. In fact, outside of that immediate post-pandemic bounce we saw back in 2020, this marks the strongest quarterly growth we've seen since the recovery began. And honestly, what's even more fascinating is the profitability behind all that growth. Net profit margins for the S&P 500 just touched 16.9%. That is the highest level we've seen since FactSet started tracking this data way back in 2009. And the strength is remarkably widespread too. A staggering 86% of companies beat their earnings estimates, which easily crushes the 5-year average of 78%. Crucially, while mega-cap tech and AI excitement are definitely leading the charge, this growth is really broad-based. We are seeing serious muscle pouring in from sectors like financials, industrials, and healthcare, too. Unsurprisingly, major institutions are reacting to all this fundamental strength. Wall Street targets are shifting upward. The average target is now sitting around $7,894. But get this, JP Morgan recently cranked their year-end target to a massive $8,000, backing that up with an earnings per share forecast of $365 for 2026. Goldman Sachs, they're right there with them, also targeting $8,000 and projecting $340 in earnings per share. Basically, Wall Street is looking at this fundamental engine and betting that it has plenty of fuel left in the tank. Now, you might be thinking, okay, record high prices, doesn't that mean stocks are totally overvalued right now? Well, let's look at the forward PE ratio. At the start of the year, it was hovering up around 26. Today, it has dropped down closer to 20. Yeah, it's still a bit higher than the 10-year average of 19, but it's way more reasonable. And why is that? It's simply because earnings are actually growing faster than prices. And frankly, that is the healthiest possible way for a bull market to sustain itself. Moving on to Section 2. Lens 2, reading the charts. Okay, so the long-term fundamentals are rock solid, but what's happening right now in the near term? Well, VOO is currently catching its breath, consolidating in the 713 to 714 range right near its recent highs. And the moving averages here tell a really clear story. VOO sits firmly above its 50-day moving average of 698, its 100-day at 690, and its 200-day at 688. Since the price is well above all 3 of those key levels, the intermediate and long-term trends remain unmistakably bullish. Real quick, before we dive into the next metric, let's just make sure we're all on the same page. The Relative Strength Index, or RSI, is just a momentum indicator. It basically measures the speed and change of price movements. Generally speaking, a value of 70 or higher means a stock is overbought, meaning it might have run up too far, too fast, and could be due for a cooldown. So applying that to VOO right now, our current RSI is at 65.5. That's definitely bullish, but it's not totally stretched just yet. But, and this is a big but, if you zoom in on the shorter-term oscillators, it's kind of like looking at a car's engine temperature gauge, and right now it is flashing a bit hot. The stochastic RSI is way up at 80, and the Williams %R is sitting at -10. In technical jargon, both of those are screaming short-term overbought conditions. So what does that actually mean for us? Well, while the main trend is absolutely up, we shouldn't be shocked if we see some consolidation or a mild pullback before we get that next big leg higher. Let's map out the actual battlegrounds here. The current pivot point is right around $709.26. We're testing immediate resistance between $709.89 and $710.48. Now, if the market can smash through that $714 mark with some solid volume, that pretty much opens the door to totally new highs. On the flip side, though, immediate support sits at $708.67. If we drop below that, we could be looking at a quick short-term pullback toward the $700 level with a much stronger safety net down at that 50-day moving average of 698.
All right, Section 3, Lens 3, the interest rate wildcard. So every engine has brakes, right? And this right here is the biggest macroeconomic threat to our rally. The whole debate over what the Federal Reserve is going to do next is completely dominating the market right now. Look, for most of this year, the market had practically guaranteed a rate hike in September. But then the data changed. We got some softer employment numbers in July, and poof, that certainty just evaporated. Right now, the market is pricing in a nearly 70% probability of a rate pause.
And behind closed doors at the big institutions, the debate is incredibly fierce right now and totally unsettled. On one hand, you have this fascinating recent study from the San Francisco Fed. They're actually suggesting that the current federal funds rate might be 50 to 75 basis points below the neutral rate. Basically, in plain English, they're arguing that monetary policy might be way less restrictive than everyone assumes, maybe even accommodative. But then, completely on the other end of the spectrum, you have Wells Fargo. They just made a super bold call, abandoning their forecast for a pause entirely. They actually expect a 25 basis point hike before the end of the year, pointing to sticky inflation from energy costs, tariffs, and all the massive capital expenditures pouring into AI right now. Now, when you zoom out and poll economists broadly, about 80% are still in the no more hikes this year camp. But I gotta tell you, that 20% minority expecting hikes, they are getting louder. And the market is hypersensitive to this stuff. If rates stay higher for longer, it really squeezes stock valuations, especially for all those tech and growth sectors that rely heavily on lower discount rates. But a pause? That's basically throwing gasoline on the fire for further gains. And hey, this isn't just a US issue. Globally, central banks like the Reserve Bank of Australia are holding rates steady right now, but they are explicitly warning everyone that inflation risks are skewed to the upside. Okay, Section 4, Conclusion. 3 key takeaways. So we're left with this incredible central tension, right? You've got historically strong earnings pulling the market upward, and then you have this completely uncertain Fed policy threatening to hold it back. So how does this play into our risk assessment? Well, VOO is absolutely fantastic for broad exposure, but you really have to be aware of the concentration risk here. The top 10 holdings in this fund make up a massive 38% of the entire thing. The remaining 490 or so companies, they share the other 62%. Because higher interest rates tend to disproportionately affect those massive tech companies in the top 10, you really need to consider your own comfort level with that heavy mega-cap exposure in today's macroeconomic environment. So to wrap this all up, here are your 3 actionable takeaways from everything we've reviewed today. Number 1, don't fight the earnings trend. Corporate profits and margins are literally the strongest they've been in years, and that is one formidable tailwind. Number 2, keep a close eye on that concentration risk we just talked about. And number 3, stay disciplined. Look, with fundamentals pulling one way and the Fed pulling the other, there will absolutely be daily volatility. Just keep your time horizon long, focus on quality, and don't let the daily noise shake you out of a solid strategy. We've explored the record corporate profits, the bullish technicals, and the incredibly divided debate on interest rates. It's a market full of immense opportunity, but there's definitely some notable risk mixed in there too. So I'll leave you with this one final thought to consider. When you look at your own portfolio, which force do you believe is going to win out? Is it the undeniable strength of corporate earnings or the looming uncertainty of Fed policy? Which one is going to drive your next move? Thanks so much for joining me for this explainer. Keep learning, stay focused, and I will see you next time.